Hello, guys. If you are looking for the simplest way to spot a stock for short term trading, this is the video that you need. Now, I'm going to share the practical steps to picking stocks for short term trading. Now, what's my own definition of short term trading? Short term trading is the period that's less than 1 year, meaning that you're buying a stock for hold for at least 6 months to 1 year, but it's not going to exceed 1 year. So the idea basically is that you're not going to hold that stock above beyond 12 months. So if your stock holding period exceed 1 year, then it's no longer a short-term stock again. So the idea behind this trading is that we're looking at buying a stock and hold them for 3, 6 months, max 12 months. So it's possible that at the end of 6 months, you might have attained your target profits, or maybe 3 months. So again, it's like a swing trading strategy where you're buying a stock to ride them until the trend is over. So at that point, when you notice that the trend is over, what happens? You start selling off your stock to take profits. So that's exactly what this means. And the best strategy to make money in the stock market is swing trading. I mean, we're looking at short term. So if you want to make money in short term from the stock market, focus on swing trading. Master the art of swing trading stock. Swing trading stock means that you're holding them as long as the uptrend is still very strong. And the moment you notice a change in the short-term trend, then you sell off. I've seen situations where a stock goes up by over 50, 60, 70, or even 100%. I'm going to show you some of the stocks that I've picked for swing trading and also short-term strategy. And I'm also holding these stocks as long as the trend is still very, very strong. Now, before we continue, before I show you how this works, there are tools that I'm going to introduce you to that I need to analyze this strategy. The first one is I use Google. Number one, I use Google to check the performance of S&P 500, which is the overall market index itself. Then the second tool I'm going to introduce you to is we then move to our charts. This is where we then look at individual stocks that might qualify for short-term trading. Then once we confirm this stock, the next part that we're going to look at now is the fair value of a stock. Remember, a lot of times people always ignore fundamental analysis in short-term trading, saying, "Oh, the market is strictly technical and all that." No, if you want to improve your chance of making money in the stock market, you can't do without fair value calculation. You can't do without valuing a company using its cash flow. And what does that does for you? It helps you to know whether the company is expensive or not. There is nothing like buying a stock of a company that is considered undervalued and also trading at the bottom of the market. It makes a lot of sense because what is going to drive that stock basically is the perception that the company is cheap. And when investors begin to see the value in that company, automatically sentiment becomes positive. Buyers' interest is automatically increased on that company. So that's why we must do a fair value calculation on the company. So I already have my Excel sheets right here to check the fair value of the company. So the idea is we want to buy a company that is selling at the bottom of the market and is considered cheap, and as well as a momentum stock. So that's what we want to do. So let's quickly look at the performance of S&P 500 so far. So when you go to Google, you type SPS 500. So this SPS 500. So in the last 5 years, SPS is up by 110%. You might now want to ask, what is SPS? SPS is the total value of the top 500 companies in the US market. That's what SPS is. SPS is the value of the top 500 companies in the market. You can see here that's SPS is Standard& Poor's 500 or simply S&P 500. It's a stock market index that tracks the performance of 500 large companies listed on stock exchange in the US. So you can see it tracks the performance of top 500 companies. You can check out top 500 companies later. You have the likes of Microsoft, Google, Apple, Facebook, Tesla, Amazon, IBM. You have a lot of them. So that's not what this video is going to talk about, discuss. So we're looking at how do you pick stocks for short-term trading? How do you improve your chance of making consistent profit in the stock market. So despite the noise, despite the Fed noise, how do you improve your chance? How do you pick the best company in this market, and as well as increase your chance of becoming profitable or consistently profitable? So the first step is to look at the performance of S&P 500. That's what I do. So I look at the performance of S&P 500 in the last 5 years, but I always use 1 year, year to date, and all that. But 5 years will just give me an idea of where the market has been coming from. You can see that in the last 5 years, SPS is up by 110%. So if you launch our chart and we go back to the monthly time frame, you will see that in the last 5 years, you can see here. So we are just ending 2021. So last 5 years will be 2016. So you can see how the market has rallied from this section up. Notice the huge rally. So despite the pullback that we have seen in the market, you can see the pullback. See pullback. You can see pullback. The market will keep going up. You can see here. So there's a whole lot of factors driving the stock market. The simple reason why stock market will continue to go up is because we consume all that they sell. So most of the companies that you see in the market, they sell what we consume. So as long as you buy product and services, the market will keep rallying higher. The second reason is that the US Fed is there to support the economy. And when economy is expected to grow, when the index are expected to do or to be better than the previous financial figures, what do you expect? The market should do better. So the Fed has always been a big supporter of the stock market indirectly, because the stock market is not just an entity in itself, it's made up of companies. And these companies are receiving boosts from the Fed. What happened? They do well. And the Fed will not allow this company to go down. Why? Because indirectly or directly, these companies are actually there to provide employment. And when there's unemployment, when companies are not doing well, what happened? They tend to shell off their staff. And when they shell off staff, what happened? It's a burden on US Fed. So US Fed would indirectly want to support businesses so that they can keep on employing. So that's the summary of the SPS 500 and why I think it will continue to go up in the next 20 to 30 years. There will always be pullback. It's a normal thing in the market. But in the long run, the market is still in a strong uptrend. So this is SPS 500. So in the last 1 year, the market is up by 26.51%. Year to date, the market is up by 27%. 6 months, the market is up by 10%. Last month, 1.51%. Now, of all this period, I only need the 1 year, year to date, and 6 months period. That is what I use to screen for the stocks that I want to buy. I only need the 1 year, year to date, and 6 months period. Why do I need that? Because we are looking at short term. Remember, we don't want to hold the stock beyond 1 year. So we need 1 year performance, 6 month performance, and then year to date performance. We are not looking for 5 years because we're not holding the stock for a long time. Now, why are we looking at this? We want to see how the index has performed so far, because this index tracks the performance of 500 companies. So if there are over 500 companies in this market, you can't tell me that it's all the 500 companies that are doing well. There are some of them that might also lag behind. But irrespective of the ones that are lagging behind, the overall index itself, meaning that a combination of the good ones and the bad ones, gives you an average of 26.151% in the last 1 year. So it means that the best companies should have outperformed 26, because this is like an average performance of all the companies, both the good and the bad. So it's likely that the good one should have outperformed the index of 26.51. So that means if we are going to be picking stock right now, we want to pick stocks that have outperformed the S&P 500 by 26.51 in the last year, and also year to date 27.1, and then in the last 6 months of 10.14. That's exactly what we are looking for. These are the kind of stock we want to trade, because the S&P 500 is made up of 500 companies, and then in these 500 companies, less than 20% of them are actually doing well. If you drill down to the performance of each of the company in the 500 S&P 500, you would notice that it's just less than 20% of the company that is driving this index. The rest 80% may not really be doing well. I've done my research and I can confirm that. So we want to pick the best companies. We want to pick the companies that are outperforming, which companies are actually attracting most attention in the market. That is what we're looking for. So that's the first step to screening for companies. You don't have to settle for um lagging companies, and also you don't have to be driven by breaking news in the market. Yes, trading news is very good in the market. You can catch explosive stock. But if you continue to do that, you may not make the consistent profits because breaking news doesn't come every time. But how do you improve your chance of buying the best company in the market? That's exactly what I'm sharing with you right now. First, look at the performance in the last 1 year, look at the performance in the last 6 months, and also year to date. So let's look at one stock that have outperformed the S&P 500, BS. So I own this stock. Now, in the last 5 years, remember, we're not long-term investor. So let's take these 5 years out. In the last 1 year, this stock is up by 108%. S&P in the last 1 year is up by 26.51%. Now, on the year to date, this stock is up by 114%. On year to date, S&P is up by 27.71%. In the last 6 months, this stock is up by 36%, and in the last 6 months, it's up by 10%. This is an example of an outperformer. This is an example of an outperformer or a momentum stock, a stock that is outperforming and is still expected to maintain its uptrend. So if the stock I want to pick is not outperforming the S&P 500, I am not buying the company. Yes, the stock might continue to do well, which I don't have any issue with. But I want to be among the few that is buying the best. My portfolio should be made up of best companies in their individual sectors or industry. So BS is a perfect example. Let's look at another company like IBM. In the last on the year to date, IBM you can see 9.51%, and on the year sorry this is in the last 1 year you can see 26.51%. IBM is 9.5%. In year to date, 10.35%, 27%. Then in 6 months you can see 5.87%, and 6 months 10 points. So this is not the kind of stock I want to trade. This is not the kind of stock I want to trade for short term. Why? Because it's already lagging behind. It's not an outperformer, it's an underperformer. Yes, you might like the business of the company. It might look so interesting. Oh, they are into IT, technology, they sell laptops, they do this. I'm not interested in that. Why? Because I'm not holding the stock for a long time. I'm interested in stocks that are on the move right now. Stocks that have the possibility or the potential or probability of going higher in coming months, 3, 4, 5, 6 months, max 1 year. So, and the stock must have shown some level of outperformance before I jump into the stock. So let's look at another company entirely. Let's see Amazon stock. So you need to note that a stock that is an underperformer today might eventually become an underperformer tomorrow. Do you understand? That also depends on the performance. So 1 year, Amazon is up by 4.18%, and the S&P is 26%. Year to date, 7.37%, and S&P is 27%. 6 months down by 0.65. You can see it. So you can see that Amazon is one of the SPX stock, but it's not an outperformer. Remember what I told you? SPS is made up of outperformers and lagging companies. So if SPS average is up by a certain number, when you factor in both the good and the bad, it means the good ones must have outperformed the market. So let's look at a company like Tesla. So in the last 1 year, Tesla is up by 60%, and then SPS 26%. Good. Year to date, 46%, and then 27%. Good. Then the last 6 months, 54%, and last 6 months 10%. That's good. So this is an example of an outperformer. So which means we might want to trade Tesla for short term. So before you settle for a stock, make sure it's an outperformer. Make sure it's already outperforming the S&P 500 in the last 1 year, year to date, and 6 months. This is very important. If you want to increase your chance of buying the best US stock that will make you money, this is the first step. Do not ignore this step. The reason a lot of people don't make money in this market is that they follow their emotion. They're emotionally attached to the market. So instead of them to go through this strategy that I just shared, which is unbiased, is not partial, they are first emotionally attached. Oh, I like Amazon because Amazon is a brand. So they'll quickly jump in. Now, Amazon is good for long-term investment, but at this point, it's not good for short-term trading based on what I just shared. So let's look at another stock again that is in S&P 500, a stock like Apple. The last 1 year, Apple is up by 28%, and then SPX is up by 26%. Year to date, Apple is up by 36%. In the last 1 year, SPX is up by 27%. And then 6 months, 30%, and SPS is up by yes. So you can see that Apple and Tesla are stocks that we might likely swing trade or trade for short term in the market because they are already outperforming the. So this is the first stage to having a list of stocks to carry out further analysis. But that's not all. We are still going to employ other metrics to confirm our trend. Now, once you have done this and you now have list of selected stocks to trade, the next one is we will then go to our charts. So look at the SPS on the chart right now. You can see here, this is a daily chart. Now, I like to use my 50 days, 100 days, and 150 days to check for trend. Now, if the trend of a stock is very, very strong, you would see that the 50 days will be strongly above the 100 days, which is above the 150 days. And each of them are lined up sequentially. You can see how each of the averages are lined up sequentially. Now, at some point, you will notice how the index always pull back to one of the averages. You can see here. So even if the index pull back, it tends to find support on either the 50 days, 100 days, or 150 days. But most of the times, I like healthy pullback to the 100 days moving average. I also like the 50 days. But when it pull back to 100 days moving average, it might be a result of market sell-off, general market sell-off. And that general market sell-off always provides an opportunity. You can see the last time it pulled back to 100 days was in 24th of September 2020, the first time here based on this chart. And from there, notice how the index has rallied, and the next time it pulled back to the 100 days was 29th of September. That's almost a year after. And then you see we have this, and then the index started rallying up. So S&P 500 is clearly on a long, short-term uptrend. So if the short-term trend is very strong and up, then you can't settle for a stock that is not outperforming this index, because by default you should have probably settled for an ETF that tracks the performance of what these 500 companies. So there are so many SPS based ETF, Vanguard ETF. Just go buy ETF and then relax and then forget about it. They will do the job for you. But if you want to outperform or you want to pick the stock, then you should be looking at buying stock that will generate better return compared to SPS 500. So let's look at some of the stocks that I mentioned earlier. So we have a stock like Tesla. Now you can see this is a stock like Tesla right now. Now look at this chart compared to SPS. Now you would notice a difference. The SPS averages are lined up sequentially. You can see that they are organized. You can see here. But Tesla's own is what? Whipsaw. You can see that the moving averages are not organized. Can you see right here? So what does that mean? It means that the volatility on this stock is very, very high. So if you are willing to pocket volatility on this stock, then but I want to buy a stock with predictable and stable return. So let's compare that to BS. Now, can you see the difference between Tesla chart and BS chart? Notice how the moving average are lined up sequentially, just like the SPS 500. You can see how they are lined up sequentially, very organized. This is the kind of stock I want to trade because the trend looks predictable. Anytime it pulls back, you can see when it pulls back to this average right here. I already bought here 110, and you can see how it rallied down to this point. Even when it pulls back, it still found support at this region, which also coincide with this previous resistance here. You can see right here, and then so this is a predictable pattern. Now, this is how to trade a stock using charts. When you notice how this index or how the moving averages are lined up sequentially like this, it tells you that there is a form of stability in the movement. The price pattern is what? Predictable. So all you need to do is wait for the price to pull back to this average, and then you jump in. Look at the last time you would have bought. That's 1, 2, 3, 4 days ago. How the index pulled back to this average. So this would have been a perfect buy opportunity. And then you see how the stock started moving higher. And if you go back, you will see we've had several pullback and see several pullback. So I like to see the average pullback to either the 50 or 100 before I jump in, and then that would take me higher. So see how an outperformance stock can be traded. One, it has to outperform the S&P 500, number one. Number two, when you look at it on charts, the moving averages has to be lined up sequentially to tell you that the trend is predictable. That's what it means. And then number three, you're looking for a stock that is pulling back to one of the moving averages. Now, is that all in stock trading? No, that's not all in the market. Now, while this will tell me that this is a stock worth trading, the next question is the price I am paying for this stock, is it worth it? That's another important question because the biggest mover of stocks are institutional investors, big fund managers. These are big boys that have that money. So they will not jump into a stock that is considered overvalued. So if you buy into a stock that's overvalued, be rest assured that you'll be struggling with fellow retail traders like you. But when you buy into a stock that is undervalued and liquidity is very, very strong, you are most likely going to see big money managers drive the stock to the upside. Now you can see the volume of this stock in a day. We have over 4.3. You can see here 4.3, 4.73 million units of that stock traded in a day. By the time you multiply it by the price, that tells you the value that is being exchanged on this stock alone. So it's the liquidity on this stock, it's very, very high. So now we are now faced with the question on whether this stock is undervalued or overvalued. This is an important question you need to ask yourself. Before you check whether a stock is undervalued or overvalued, always look at the financials of the company. So here we'll go to Yahoo Finance. This is what we need Yahoo Finance right now. So we'll go to Yahoo Finance. We want to see the financials of this company. We want to know if the stock is actually cheap. Now, being cheap, it's not about fair value calculation. You need to be sure that the company has recorded impressive growth in the last 3 years. These are some of the fundamentals that you need. Now, you may not necessarily do a deep research because you're not holding for a long time, but you still need to be sure that the company is cheap because the guys that are going to drive this stock for you, they are institutional managers and they also want to buy into a cheap stock. So when you follow the money, when you go to stocks that people are buying, you are most likely going to see your stock appreciate. So that's why I do not skip this part. So valuation is still very important for short-term investor. Why? Because you want to buy into a stock that is considered undervalued. So when it's undervalued, it's likely that 3, 4, 6 months max 1 year you should see your stock approach. Now, it doesn't mean that all the undervalued stock will increase, but you are trying to improve your probability of buying into stocks that will go up because short-term traders make money from when capital appreciation. And how does capital appreciation work? When the price keep increasing. What will attract people to a stock and pay higher fare or higher amount for that stock? When it's considered cheap. So that's why you need to do your fair value calculation. So look at the fundamentals. So revenue in the last 3 years. So you can see here 5.7, 6.1, 5.2, and then 15. Notice the massive growth right here. Fine. Then net income we see 1.52, 1.0, 5.2. So this is like almost 5 times. So this is like all-time high so far. And then you can check the cash flow, the net income. So let's look at the cash flow. This is what we then need to value the company. Now, the fourth tool we would then need is my Excel sheet, which I use for fair value calculation. Now, this Excel sheet had made fair value calculation so easy for me that I don't need to stress my head around um, future cash flow. All I need to do is enter the symbol and then key in three or four figures. That's all. System automatically calculates the fair value for me. So what I'm looking for is the estimate. It's not really an actual figure. So fair value calculation, it's not an actual figure. It's the range. Like how much do you think this stock should be selling for? Then you now compare with what the market is saying. So we'll type BS here, and then look at the cash flow, how BS has been cash flow positive the last 3 years. And then you can see the free cash flow. So what's the free cash flow? Right here, 5 billion. So 1,000 here, 5,024,752. So we punch this here, 5,024,752, 1, 2, 3. So this, so what is the growth rate of that company? So we'll go to statistics. Now, everything you need to value a company, they are on Yahoo Finance. So let's wait. So while we're waiting for this to load, okay, good. So first, we need our growth rates in the next 5 years. Before we punch in growth rate, sorry, let's look at the cash flow. So total cash, 5.09 billion. So here, 509. So these are the things we need: the cash flow, the growth, the share outstanding, debt level, and then the total cash and short-term investment. So the debt level of this stock, total debt is 8.52 billion. So 8.52. And then what's the share outstanding? The share outstanding is 683.15 million. 683.15 million. So to get the growth rate, we go to analysis. Okay, so this is the growth rate. So this you can see 5 years, next 5 years per annum, 29.15. So if I want to be fair, I could say let's start with 20 or 25. So here, so let's do 20. So we've been able to impute the cash flow of the company, followed by the share outstanding, debt level, total cash, and also the expected growth rate of the company. So how much should we be looking at right here? You can see from our fair value calculation, BS should be selling for an average of 440.24. Now, to provide for error, what if we are wrong? What if we have overstated the figures and all that? We do not want to pay more than 70% of the value. So you need to reduce it by 30%. That's what we call margin of safety. So I do not want to pay more than $296. So what margin of safety does for me is that if I'm wrong in my calculation, you need to cut down your estimate. So you don't overestimate or you don't go for a figure that is too not realistic. So my margin of safety tells me that I shouldn't pay more than $296. And what is the current price? 135. You can see right here, $135. So is BS considered cheap? Yes, it's still very cheap. compared to its fair value or margin of safety. So we're looking at $296. So $296 is still above. So that is a typical example of a stock I want to buy. One, it's outperforming the S&P 500, number one. Number two, its moving averages are lined up. That tells me that the trend is predictable. And then number three is that it's selling at one of the averages, which at this point is 150. And then number four is that it's considered undervalued based on our fair value calculation. So if you can find a stock that meets this criteria that I shared with you, you will most likely build a portfolio of profitable short-term trade. That is how I trade stock for short term. That's how I've been in this market. I can also show you more stocks that I've traded in the past and I'm still holding them. Like here, this is Intuit. I started buying Intuit at 332, 300, I think within this range. I think it's far back. Yes. You can see how Intuit from November had moved from 322 to as high as 600. I'm still holding this stock. Now, why am I still holding this stock? You notice how the moving averages, remember what I said, with the moving average lined up sequentially above each other, it's a sign of predictability. So look at how the 50 days is still above the 100 days and 100 days above. So that tells you that the trend is still very much strong. At what point should you consider a sell on this company? The best time to sell this company is when the 50 days moving average has crossed the 100 days to the downside. So when you see market dip like this, don't panic. When you see market dip like this, don't panic because as the price moves higher, it doesn't move in a straight line. There will always be dip in between. But despite that, your own decision is driven by the moving averages and not the price. When you ignore the price movement like this, after you have done your analysis, you see how you'd have made over 100% on this company's stock. That is how to trade this stock. Now, we can also go ahead to check the fundamentals of Intuit. Now, there are also sometimes when the price of a stock might be above its fair value, maybe because investors or analysts are expecting a bigger valuation, or maybe they think the company is worth more than what it's currently selling for. Do you understand? So when you do your fair value and you notice that the price of the company is above the fair value, you have to be very careful. But if it's a company that has a very, very good history of increasing returns, increasing revenue, increasing profits, you might consider a hold as long as the moving averages. That's why I said your biggest driver may not necessarily be the fair value because you are only estimating. What if you're wrong? So your biggest driver of when to sell should be the moving average. So if by the time this stock crosses below the 50, crosses below 100, crosses below 200 and start dipping, and then you see the 50 cross the 100 to the downside, then you might consider a sell and call it goodbye. So if you have started holding this stock and you saw this dip, and because of panic you quickly sold off this stock, you see how you would have missed massive rally. So your decision should be driven by the moving averages and not necessarily the stock price, because stock price is noisy. The market is noisy by default. So you will most likely make money if you take decision uh that's based on moving averages and not necessarily the stock price. So you can see this is Intuit. So let's look at the financials of Intuit. The last 3 years, you see 6.7, 7.6, 9.6, and 10.3. Then net income 1.5, 1.8, 2.0, 2.09. So fine. So let's go to the cash flow. So this is a cash flow positive company. Operating cash flow is positive, and then free cash flow is also positive. So let's punch in this figure. So what is the symbol of this company into? Notice that the moment I input the symbol of this company, the price automatically changes. You see here, see why? Because this sheet is connected to Google Finance. So $635. So what is the cash flow of Intuit? 3221,000. So all in thousand, yes. 3221. So come here. 3221, 123, 123. Yeah. So what is the expected growth rates of the company under analysis? Analysts are projecting a growth rate of 17.4%. So let's go with 17%. And then what's the share outstanding of this company? So go back to Yahoo Finance, you click on statistics. The share outstanding is 283.17 million. So 283.17 million. What's the debt level of this company? The debt level of this company is 2.51 billion. 2.51 billion. And then what's the total cash position of this company? Total cash position is 3.25 billion. Total cash position is 3.25 billion. So having repeated the figures like the cash flow, the growth rates, debt level, share outstanding, and total cash flow, you can see right here that the fair value of this company is what? 559. And then the margin of safety is 391. What's the current share price? 635. You can see that this company is 12% undervalued. So 12% undervalued. So our fair value is saying that this company should be selling for 559. So let's go back to our chart and locate 559. So you can see 559 is right here at exactly the 150 days moving average around here. This is where our fair value should be sitting on. So if Intuit, for instance, dips to this point, it's a big buy. But right now, the company is selling above that level. So for anyone looking at buying this company right now, I do not think this is worth entering again. There are other companies. You have over 10,000 companies to choose from. So you shouldn't be struggling to jump into this company because I think that the price might have gone or moved ahead of its intrinsic value. For someone that is still holding this company, it's not a sell either. Why? The moving averages are still lined up sequentially. So for me that I started holding this company when it was 332, you can see up to this point, I'm still holding this stock because the moving averages are lined up. So let's even look at the performance too against S&P 500. So in the last 1 year, this stock is up by 66%. S&P is up by 26. Year to date is up by 71, and S&P is up by 27, and then in the last 6 months it's up by 30%, and S&P is up by 10%. So this is a clear outperformer. It's outperforming S&P 500, and at the same time the indices are lined up, even though it's on overvalued. So for someone that is still holding it, I'm still not considering a sell, but for someone that's looking at buying, it's still not a buy. So you might need to wait for a significant dip before you jump in to the company. So this is how I pitch stocks for short-term trading. So if I'm going to trade this, this stock for short term, imagine when we had a dip to this moving averages in March at 372, and then you began to ride this company. So even when we had a dip to this point, the moving averages did not cross, and then you can see how it bounced back. So from March to December, so from 372 to 635. That's 635 minus 372. 263 divided by 372. That should have given you 70% return from March to December. This is how to trade stock for short term. This is how to trade momentum stock. So you can improve your chance of buying the best company in the market if you look for stocks that are outperforming the index, number one. If you look for stocks that its moving averages are lined up sequentially with 50 above 100, 100 above 50, and then make sure you buy them when they are pulling back, when they've just pulled back to one of the averages, as long as they are undervalued. So let me show you another undervalued stock. um let's look at IT. So can we just look at Apple stocks? Now notice Apple stocks. So I'm not going to buy Apple stock at this point. So now it doesn't mean that when moving averages are not lined up, the stock is not a buy. You understand? It only tells you that the volatility sometimes might be huge. You can see here, you can see. So that is what it means. But I would prefer to buy into a company with its moving average lined up sequentially. Look at a stock like Nvidia right now. You can see the moving averages here. You can see right here. Now, with the moving averages lining up sequentially, it doesn't mean you have to line up in the last 5 years. So for me, I look at minimum of 3, 4, 5 months. So if moving averages are lined up for a minimum of 3, 4 months, then it's fine. Like this December to November, they are still lined up. November to September, October, September. You can see here. So it still tells me that it's a good stock and then the trend are predictable. So look at Nvidia right now. Let's now go through the step that I mentioned. Nvidia stock, the last 1 year is up by 129%, 26. Last on the year to date, 126% year to date, and then 6 months, 48%, 6 months. So Nvidia is a clear performer, as you all know. Then on charts, you can see the moving averages are lined up sequentially right here. Now, when is the best time to buy? The best time to buy is on a pullback. So look at the pullback here, which is around 197, 198. Notice the rally and then another pullback to the 50 days moving average. So this is it here. So another buy opportunity. Now, when I buy on 50 days moving average, I don't jump in at once because I've seen situations where a stock would dip to moving average, will recover a little and then dip further to 100 days moving average. So sometimes the amount I allocate at 50 days level, it's not that much compared to when it's trading at 100 days moving average. Yes, even though it's likely going to bounce back for 50 days moving average, but my assurance seems to be stronger. My entry level seems to be stronger at the 100 days moving average. Now, can we look at the valuation behind Nvidia stock? So we then go to Yahoo Finance. So let's go to our sheets. Symbol NVDA. Nvidia. Now this is Nvidia on Yahoo Finance. Then financials. Like I said before, we are only paying attention. We are only employing fundamental analysis because we want to follow the money, because we want to buy the type of stocks institutional managers are buying. So that's why we're doing this. Let me try Nvidia, another browser. Okay, so this is revenue in the last 3 years: 11, 10, 16, and 24. Now, this trailing 12 months is the last 4 quarters, and it tells you whether a company is on track to beat its previous financials. So, me, I consider it 1 year, two. So, we're looking at 1, 2, 3. So, Nvidia passed my checklist on that. And then the net income, you can see 4.1, 2.7, 4.3, and 8.2. So, let's look at the cash flow of Nvidia. So operating cash flow positive 3.7, 4.7, 5.8, and 8.1. And then free cash flow too positive. So what's the free cash flow? 7156 million. So 7156, 123, 123. Yeah. And then analysis. We want to check the estimated growth rate in the next 5 years. What are analysts projecting in the next 5 years? So here, let me quickly open the statistics to make it easier for us. information that we need. Okay, so let's plug in total cash first. So total cash of 19.3 billion. So total cash of 19.3 billion, and then debt level of 11.83 billion. And then a share outstanding of 2.49 billion. 2.49. So now need the growth rates. So let's get the estimated growth rate of this company. So next 5 years, analysts are projecting 39. You can see 39. So let's try 30%. So with this figure that we've entered, from the free cash flow to the growth rate to the share outstanding to debt level, total cash, Nvidia should be selling for, you can see the price, 299. That's the intrinsic value. And then the margin of safety is 209. But the current share price is 296. You can see here 296. So it's, let me say, fairly valued at 296. You can see Nvidia fairly valued at 296. So for me, I probably wait for this company to dip to like 240. But already I'm already in. You can see when it dipped to 197 here. So this was a perfect entry for me. So 197 up to 337. You can see here. So 337 minus 197. That's like 140. 140 divided by 197. That's what? 71%. You can see a rally from this point to this region. So that's between October and November. You can see how Nvidia rallied so high. So if I change the growth rate to 35. Remember, analysts are projecting 39. So if we go with 39%, so Nvidia should be selling for $488. So in between, I still think the company is grossly undervalued. The company is still grossly undervalued from our projection, from analyst projection, because we didn't estimate this. Now, the projection you see there are based on average of different analysts. So that's what we're seeing here. So if analysts are projecting 39%, by the time you plug in 39%, we have a fair value of $488, and then the company is selling for 296. So the fair value calculation will help you pick stocks that are likely going to be snapped up by what? Institutional investors. So let me recap the stages or the steps to picking stocks for short-term trading. Number one, look for stocks that is outperforming the S&P 500, just like I showed you here. Number one. Number two, make sure the moving averages are lined up sequentially in the last 3, 4, 5 months. The longer the number of months, the more predictable the trend is. Number four, make sure the stock has just pulled back to its moving average. So it can be either the 50, 100, or 150. And then before you buy, do your fair value calculation to be sure that the company is grossly undervalued, meaning that the fair value is higher than the market price of the company. So you increase your chance of picking stock that will most likely go up in short term. And then minimum hold 3, 4, 5, 6 months. Remember, you're not holding this stock beyond 1 year. That's what short-term trading is all about, and that's what swing trading is also all about. So imagine someone that started buying from here, how he decided to keep holding this stock. Now, even when we had a deeper crash here, you are not going to sell because the moving averages are still lined up. So you can see with the moving average, you are in charge. You are emotionally disconnected from the market because this is enough for you to quickly sell. But when you sell right here, which is how the stock bounced back again, and you can see the pullback here, you're not moved because the moving averages are still lined up sequentially. So that's the best time that's the best tool to know whether it's time to sell or not the price itself, because there will always be price swing. Price will go up today, it will come down tomorrow, go up today. But you can always use moving average to know whether you should continue to stay in or hold the stock or sell off your stock holding. So this is a strictly strategy to picking stocks for short term and ensuring that you continue to maintain a winning portfolio in the US stock market. So I hope you enjoyed my brief tutorial, and feel free to like this video, share, and also subscribe to this channel, as I intend to shell out more interesting stock trading videos.